Defensive ETFs are designed to provide stability and mitigate losses during market downturns. Unlike growth-oriented investments that thrive in bull markets, defensive assets tend to be less sensitive to economic cycles. They typically invest in companies or sectors that provide essential goods and services, which remain in demand regardless of the economic climate. Key characteristics of defensive ETFs include a lower volatility. These funds generally exhibit lower price fluctuations compared to the broader market, offering a smoother ride during turbulent times. A stable earnings and dividends. Companies held by defensive ETFs often have consistent revenue streams and a history of paying reliable dividends, providing a cushion during market stress. Are essential goods and services. They focus on sectors like consumer staples, healthcare, and utilities, where demand is relatively inelastic. To identify the best defensive ETFs for 2026, we have analyzed a selection of funds based on their historical performance during market downturns, their underlying holdings, expense ratios, and overall suitability for a defensive strategy. While past performance is not indicative of future results, it provides valuable insight into how these funds might behave in a market crash scenario. 1. Invesco S&P 500 Low Volatility ETF, SPLV. SPLV tracks the S&P 500 Low Volatility Index, which comprises the 100 stocks from the S&P 500 with the lowest realized volatility over the past 12 months. This methodology aims to provide exposure to the S&P 500 with less risk than the broader market. This ETF returned 8.92% in the last 365 days. SPLV's holdings typically include a significant allocation to defensive sectors such as utilities, consumer staples, and healthcare. Its focus on low volatility stocks means it may lag during strong bull markets but offers significant protection during downturns. The predicted value for SPLV in 2026 is set at an average of $69.79, with estimates ranging from a peak of $76.13 to a trough of $62. This suggests a relatively stable outlook, consistent with its defensive nature. 2. Vanguard Consumer Staples Index Fund ETF Shares, VDC. VDC invests in companies that produce consumer staples, providing exposure to a sector known for its stability and consistent demand. It tracks the MSCI US Investable Market Consumer Staples 2550 Index. This ETF returned 6.73% in the last 365 days. VDC's portfolio includes household names like Procter & Gamble, Coca-Cola, and Walmart. These companies tend to have stable earnings and often pay dividends, making them attractive during uncertain economic times. The U.S. economy is expected to slow down in 2026, with a projected GDP growth rate of 1.5% and inflation at 2.5%. This environment typically favors consumer staples, as demand for essential goods remains resilient. 3. iShares Edge MSCI Minute Vol USA ETF, USMV. USMV seeks to track the investment results of an index composed of U.S. equities that have lower volatility characteristics relative to the broader U.S. equity market. It uses an optimization process to construct a portfolio with the lowest possible absolute volatility. This ETF returned 7.27% in the last 365 days. USMV's holdings are diversified across various sectors, with a tilt towards defensive industries. Its construction methodology aims to minimize overall portfolio volatility, making it a strong contender for risk-averse investors. Its returns were nearly 20% less volatile than the MSCI USA index from its October 2011 inception through March 2025, demonstrating its effectiveness as a defensive tool. 4. Vanguard Healthcare ETF, VHT. VHT provides broad exposure to the U.S. healthcare sector, including companies involved in pharmaceuticals, biotechnology, healthcare equipment, and services. It tracks the MSCI US Investable Market Healthcare 2550 Index. This ETF returned 8.35% in the last 365 days. The healthcare sector is known for its non-cyclical nature and consistent demand. VHT's holdings include major pharmaceutical companies, medical device manufacturers, and healthcare service providers, which tend to perform well regardless of economic conditions. The aging global population and ongoing advancements in medical technology ensure a steady demand for healthcare products and services, providing a strong fundamental basis for VHT's defensive characteristics. 5. SPDR Gold Shares, GLD. GLD is one of the largest and most liquid gold ETFs, designed to track the price of gold bullion. It holds physical gold in vaults, providing investors with direct exposure to the precious metal. This ETF returned 36% in the last 365 days. Gold's role as a safe haven asset is well established. During periods of market uncertainty, inflation, or geopolitical tension, gold often acts as a hedge against equity market declines. J.P. Morgan Research expects gold prices to average $3,675 per ounce by Q4 2025, rising towards $4,000 per ounce by Q2 2026. This bullish outlook, coupled with central bank buying and strong fundamentals, reinforces GLD's position as a defensive asset. 6. iShares Gold Trust, IAU. IAU is another popular gold ETF that seeks to reflect the performance of the price of gold. Similar to GLD, it holds physical gold, offering a cost-effective way to invest in the precious metal. This ETF returned 36% in the last 365 days. IAU shares the same fundamental defensive characteristics as GLD, benefiting from gold's historical role as a safe haven. Its slightly lower expense ratio compared to GLD can make it an attractive option for long-term investors seeking cost efficiency in their gold exposure. 7. Sprott Physical Gold Trust, PHYS. PHYS is a closed-end trust that invests primarily in unencumbered, fully allocated physical gold bullion. Unlike GLD and IAU, PHYS is structured as a trust, which may offer certain tax advantages for some investors. This ETF returned 37% in the last 365 days. PHYS provides direct exposure to physical gold, making it a pure-play defensive asset. Its structure as a trust ensures that investors own actual gold, not just a promise to deliver it. This direct ownership can be particularly appealing during extreme market stress. PHYS has outperformed the broader market in the last year, demonstrating its defensive capabilities. 8. Vanguard Short-Term Bond ETF, BSV. BSV invests in a diversified portfolio of high-quality, short-term U.S. government and corporate bonds. It aims to provide current income while maintaining a low duration, making it less sensitive to interest rate changes. This ETF returned 4.75% in the last 365 days. Short-term bonds are a cornerstone of defensive portfolios due to their capital preservation characteristics and low correlation with equities. BSV's focus on short-duration, high-quality bonds makes it an ideal choice for investors seeking stability and liquidity during market downturns. In a rising interest rate environment, short-term bonds tend to perform better than long-term bonds, further enhancing their defensive appeal. 9. Schwab Short-Term U.S. Treasury ETF, SCHO. SCHO invests exclusively in short-term U.S. Treasury bonds, providing direct exposure to the safest debt instruments in the world. It tracks the Bloomberg U.S. Treasury 1 to 3-year index. This ETF returned 4.49% in the last 365 days. U.S. Treasury bonds are considered risk-free assets, making SCHO an excellent choice for capital preservation during market crashes. Its focus on short-term maturities minimizes interest rate risk, providing a stable anchor for a diversified portfolio. SCHO is particularly attractive when investors prioritize safety and liquidity over higher returns, which is often the case during periods of market stress. 10. iShares Core U.S. Aggregate Bond ETF, AGG. AGG provides broad exposure to the U.S. investment-grade bond market, including U.S. Treasuries, government-related bonds, corporate bonds, and mortgage-backed securities. It tracks the Bloomberg U.S. Aggregate Bond Index. This ETF returned 3.05% in the last 365 days. While not exclusively short-term, AGG offers diversified exposure to the broader bond market, which typically acts as a defensive asset class. Its high credit quality holdings and diversification across various bond types provide a stable foundation for a portfolio. AGG's role is to provide a counterbalance to equity risk, offering modest returns and capital preservation during equity market downturns. Its broad market exposure makes it a suitable core holding for defensive investors. Building a defensive portfolio is a crucial strategy for navigating the inherent uncertainties of the financial markets. As we approach 2026, the ETFs discussed in this write-up offer compelling options for investors seeking to mitigate risk and preserve capital during potential market crashes. By understanding the fundamental characteristics of defensive sectors, such as low volatility, consumer staples, healthcare, gold, and short-term bonds, investors can strategically allocate their assets to enhance portfolio resilience. The 10 ETFs highlighted represent a diverse range of defensive strategies, each with its unique risk-reward profile. While low volatility and consumer staples ETFs aim to provide stability through resilient earnings, gold ETFs offer a traditional safe haven, and short-term bond ETFs prioritize capital preservation and liquidity. Combining these various defensive assets can create a well-rounded portfolio capable of withstanding significant market turbulence. It is imperative for investors to conduct their own due diligence and consider their individual risk tolerance and investment objectives before making any investment decisions. The economic landscape is dynamic, and continuous monitoring of market conditions and portfolio adjustments will be key to long-term success. By embracing a defensive mindset and leveraging these robust ETF options, investors can position themselves to not only survive but potentially thrive amidst future market challenges.